Good morning, good morning, good morning, good morning. If you wanted some clarity this morning for these confusing charts at times, you came to the right place. You came to the right place. You know what we're going to get into today. We're going to focus on the macros first. We're going to focus on everything impacting the macro picture for gold specifically. I have to be specific when I specify what we're focused on: gold and macros. We'll trade gold futures, we'll trade gold forex. However, we're day trading gold is where we're going to be. um and that's just day trading. Like we look for other investments and whatnot, so that's just day trading. It's not like we're only investing into gold, just only day trading gold, right? Been day trading gold for a long time now, right? 6 7 years, which honestly isn't that long when you start to understand how long people have been in this game, and just the process, right? So the more that we've learned about gold and traded gold, we've shifted our focus to just focusing on the fundamentals and allowing the execution to simply just be your green light, but ultimately not trading without the signal from the fundamentals. And so right now, gold, there's three things going on with gold in terms of what we're seeing, not just what we're seeing on the price, but the force behind the price, right? And so, I mean, it's down about 15% from its all-time high. Um, but why? That is the question that matters most to ask, or you're not going to understand how to adapt, or you're just going to be trading blind. Like, I use this on my last live stream, I think, maybe, but it's like a traffic signal. Like, if there were no traffic signals or there were no street signs, then people wouldn't know how to drive. I mean, I'm in Arizona, people don't know how to drive anyway, so yeah, you have that. But yeah, man, and without the macros, you're trading blind. And so we got the Strait of Hormuz, right? We got the Fed in terms of policy, and then we got central bank demand, which I think is not talked about enough. Um, and I personally have overlooked it in this current climate, right? So let's go ahead and let me share my screen. Let me share my screen. Let's go. We're gonna share on my trading view. So let me get out of that. Let me go. Ooh, trading view is actually in full screen. I concluded that I do need another screen. Like, if I had another screen up here, man, that would be money. I don't know if I need three, but I'm willing to take, not take the risk, but go the length to see if I do need three. So go right now. Let me get rid of this really quick just so we can see it down on my account right now. It's my funded account. Um it just showed my user ID, which is great. But yeah, this is gold right now. You see the respect of this 1 hour decision making level. You see just the trade from decision making level to decision making level. But you see that we had this long drop, right? About a couple weeks ago. What is it, April? So a week ago, right? About a week ago. But then we just been kind of ranging, and yes, these are decent movements, right? Because we're talking about the 1 hour time frame. So you're talking about 50 points upwards, another 50 downwards. But I don't want to necessarily trade in that. let me reverse. What I'm getting at is the because the fundamentals and things have been so up and down in terms of in favor for gold. Gold's responding to stagflation positively. Gold's responding to stagflation negatively. Like gold's been operating on a very interesting dynamic, and I think we've seen that in on this 1 hour time frame is a good way to look at it because these are decent swings in price up and downwards, but still within this range, right? We haven't necessarily really broken out of this range that we're in since we've gotten here. Um, so yeah, even looking at to get zoom out a little bit more, this $200 price range right here, this $200 to $300 price range here, it's been somewhat of a constant price range for quite some time now. And you know you weigh the probabilities, you think of the likelihood of us of breaking out, right? And you look at it from a technical standpoint, and you can kind of only conclude so much. But if you look at it from a fundamental standpoint, it's easy to conclude that you know you, you, I'd personally not even looking at all-time highs and all-time lows. Because there's a trading psychology that happens to traders when we get to an all-time high, when price gets to an all-time high, and you're like, okay, no way it's gonna go higher from here, right? But if you're looking at it fundamentally, that's what we're doing now. When you look at it fundamentally, you understand the force behind the movement, regardless of the price level, right? Regardless of the price level, that's not going to be your deciding factor. Your deciding factor is going to be something that actually has some force behind it, some truth behind it. Um, but yeah, we got news today. 7 o'clock, 21 minutes. We got services PMI, non-manufacturing. If you're not sure what that is, it's going to be an indication for business activity, new orders, backlog of orders, export orders, inventory chain, sentiment, import prices, employment. So it measures a lot of things, right? Orders to the service producers make up about 90% of the U.S. economy. Mm. So this is an important one to see because based on the index reading above 50% indicates the economy is generally expanding. Below and indicates it's declining. And for something that makes up 90% of the US economy in some capacity, I think in the current climate, it's important to look at this folder today, right? And this is when we talk about this up and down movement that gold has had. One of the driving factors that impacts gold prices is Fed policy, which is the second, of the three focal points I talked about at the beginning of the intro. Right? It's Fed policy. And so Fed policy, they've, said, I think they had it at 3 cuts at first for the 2026. Then it got cut to 1. Then it's been 0. Then it's been 1, right? And like there's just been this back and forth, right? And now hopefully there becomes some resolution between the U.S. Iran Israel war that lowers the uncertainty and just chaos around energy prices and oil when it comes to the strait. But then that also provides the Fed a little bit more certainty in terms of the inflation outlook, because right now it's just uncertainty. We don't know how long this is going to last, and we know the consequences are vital the longer it lasts, right? And so something like services PMI, if this comes out They have it at forecasted at 53.7, right? But it says below 50% indicates that it's generally declining. Okay. I want us to be like, just be logical when we're looking at something like this, because if we were in the prior month, this was at 54. If we were at 51, wouldn't that mean we were declining? Exactly. Yes, it would mean we were declining. So even though it's not below 50, we are still declining from the last month, right? Because now we go from 51 to 48. Now we're below 40, we're below 50. And by this definition, we are declining, but we've noticed this decline of the last 2 months. You know what I'm saying? So that decline, though, is what the Fed is more um, attracted to lower interest rates. Okay, so that decline in expansion, right, from an economic standpoint, that decline is what is appetizing and attractive for the Fed to cut policy. So it's important for us to pay attention to these news folders. Like I said, it's all time. You'll never get rid of them. Like, there's no one folder you can learn. Well, I mean, there's one folder you can learn, but um, just learning one concept, like let's take inflation, for example, and strictly how it impacts gold or whatever asset you trade. But on this channel, we're talking gold. All right, we're talking gold. And so if you just learn one concept, how inflation impacts gold, okay, that concept, you're always going to be learning how to apply, how to observe, how to identify in real time in terms of all the variables that impact it, that ultimately impact policy, that ultimately impact gold, right? It's not complex once you actually get into it. I promise you, it's not complex once you actually get into it. And I promise you, if I could redo trading, so I've been trading since I was 20 years old, 21 years old. So what is that? 7, 8 years now, right? Some on and off periods between there. Of course, just like any venture, right? On and off periods for which reason. But if I could go back, if I had an additional 5, 6 years on on learning on the macros, that would be amazing. So like what I'm saying is, if you just start out, trading psychology, of course, is important. Don't come for me. And for those of you that watch this, that trade, that's gonna say trading psychology. Yes, trading psychology is a constant, always. Risk management, trade psychology, always, right? But before you even touch the candlesticks, before you even read anything about a candlestick or an indicator or support and resistance or anything, bullish flags, all that mess, focus on the fundamentals, the macros. This what I'm looking at right now. Focus on this stuff, right? And you'll be good. You'll be good. So this conversation began by me bringing up this screen here to show the news that's 15 minutes out for us, and what the Fed is looking for, why this news is important for us to pay attention to. Same is true for JOLTS job openings. So JOLTS job openings is essentially taking 50 states and the District of Columbia. It's going to collect data from about 16,000 establishments, including retailers and manufacturers, as well as federal, state, and local government entities, right? And it's going to assess the demand for labor in the U.S. labor market and gain attention. Let's see, it's a market indicator. No, that's not what I wanted to read. It's okay. In the United States, job openings refer to all positions that are open, not filled on the last business day of the month. Okay, so it's going to take 16,000 establishments of all these, and it's going to look at all the jobs that are not filled. Okay, so we have JOLTS job openings. And then every Thursday, because I have this on heavy impactful news. Every Thursday, we typically have unemployment. Are we not going to have it this Thursday because I'm saying every Thursday we do? No, look, yeah. Every Thursday we have unemployment claims, right? This is like initial jobless claims. And so if you think of at the end of the business day each month, Joe's job openings comes out and it measures those 16,000 establishments and how many open jobs are not filled. Every Thursday we have jobless claims come out to show how many people are unemployed, essentially, right? And so we basically have two indications, two macro indications, two fundamental indications of the US economy. And you can find this information for any other economy. So if you trade Forex, I do recommend understanding what both pairs, both currencies of the pair are doing from a fundamental sense, right? But we have two indications of the labor market. So it's really, we can simply, for very simple terms on this live stream, I know there are more pieces to it, but if we could simply just look at the jobless claims and the job openings and take them apples to apples from a duration scale on a monthly scale and say, okay, how many unemployed people are there and how many open jobs are there? And the larger this, the larger or smaller this number gets, we can say, okay, how does that impact gold? If this number is larger in terms of the difference, how does that impact gold? This number is smaller in terms of the difference, how does that impact gold? I will say a 1-to-1 is typically like caution. Like there's some caution when we talk about maximum employment is one of the Fed's dual mandates. And so if we ever had a 1-to-1 rate in terms of for every one job open, there was one person unemployed, that would kind of be like a cautious type of thing. I can definitely see that being more of a, depending on what the inflation picture looks like, but more of a dovish type of Fed tone, which simply means they want to cut rates. I'm going to use, I like to use the terms that you're going to see and hear. But I will always explain if I ever use some, jargon, finance jargon like dovish or hawkish. But those are important things to know, because if you're ever watching a Fed speech, they will ask, Fed Chair Powell, who won't be Fed Chair Powell much longer, but they'll ask them, like, is the Fed taking a more hawkish tone, a more dovish approach? And you just need to know what that means on the fly so you can just listen to what his response is or her response is, right? Because that is the juice, right? That is the juice. So when you go to headlines, you're not swayed by the headlines, right? Because the headlines sometimes is just misleading. But yeah, we got, a 1-to-1, a little bit cautious. So you think about, okay, for every, two job openings, there's one person unemployed. You said, okay, that's a pretty healthy labor market. Those people unemployed, maybe they're just not actively looking for work, and maybe for the for the people that are hiring for every, two jobs opening, maybe they're just selective on the talent they're bringing to the table. Right. But, maybe look at a 3-to-1. I don't know if it ever gets there. I would personally think the higher, the healthier. However, you get into a scenario where if companies are trying to have too many job openings, that means they're not producing enough. Like something's going on, or maybe they're expanding, right? And then we have to think of the Fed. If businesses are expanding, too aggressively, right? that could then cause prices to increase, which could then cause the Fed to increase rates, right? I'm just trying to, not trying, but when I'm on these live streams, when price isn't doing much, we're going to focus on the fundamentals. I've spent all the time talking about the fundamentals today. But I just want you to start getting and thinking about these things and looking about these things. Did I say try again? I don't forget try. You're going to start, I want you to start looking at these things through this macro lens, so you don't have to look at the noise. I took a few, I'm going to show you a few things on this chart now. I took a few buys yesterday, but it was strictly behavioral injuries. And I say that because I didn't trade my system. Number one, yes, 7 years into trading, still not trading a system. And this is a system that I got probably 3-4 years ago at this point. Not trading my system, wanted to try something, right? However, I wasn't leaning on the fundamentals, because the fundamentals actually, so I wasn't leaning on the fundamentals from like a complete backdrop sense, but I was leaning on the fundamentals from a DXY sense. So last night the DXY was falling, right? It was about in this area. Last night the DXY was falling, and so I took a buy, right? And I got stopped out. Because I was trading against the fundamentals, I wanted a relatively tighter stop, right? But then I was like, oh man, if price is gonna go down, that's actually in line with the fundamentals. So I took a sell. And then, and I did that probably another 2 times. But my stop loss, my risk was so tight on both of them because I wasn't trading my system. Like normally, I'm not going to say when I'm trading my system, my risk isn't tight. What I'm saying is I was just kind of saying, okay, if it breaks this structure, kick me out, which is fine. I was just identifying points of invalidation. But I say all that to say there were behavioral entries because I was simply just entering out of feeling, right? And not out of what I was supposed to be focused on. That's important to reduce the noise, because the more trades we take, the lower our probabilities become. The greater our risk becomes. But that is a simple way to think about it. More trades, more risk, lower probability. Less trades, less risk, probability increases. We can guarantee that because we're taking less trades. We're exposing ourselves less. So if we know it's a game of probabilities, we know we can't take 100%. We know we can't win 100% of the time when our edge presents itself, right? If you think just because your edge is so fantastic, you've been profitable to this point, fantastic. But if you think that you're always going to be 100% accurate every time, 90%, right? I'm talking these really aggressive numbers, which is it possible? Yes, but we're talking about probable, right? Then you're not thinking about it from a sense of probabilities. If you think it's going to be, 90% of the time I'm going to be right, 100% of the time I'm going to be right, 80% of the time I'm going to be right. You're going to be right a lot, but you have to remember the percentages can be skewed based on how many trades we're talking about. So I can say on a 50% system, I have a 50% system, but that's on 100 trades, right? But I can also say I have a 100% system, and that's on a series of 10 trades. You know what I'm saying? So it can be skewed based on how many trades are at stores. So like that's why I worked really hard at this, and it really helped me to pull myself away from percentages and focused on R multiples, risk multiples, right? How much am I risking and how much am I being rewarded? Mm, okay. So the less trades I take, the greater my probability becomes and the less risk I have associated. Hmm. So if I only risk $250 per trade, but I make 1,000 per trade, okay, so that's about a 4 to 1, 3 to 1, 3 to 1. Interesting. Well, no, it's a 4 to 1. 250, half, 2 to 1 would be 500, 3 to 1. Yeah, that's a 4 to 1. That's a 4 to 1. Hmm. Okay. So even if I make 500 and risk 200, 250, still doubling what I'm risking, but I'm taking less trades. Okay. So then you start to do the math and it starts to make more sense over a longer series of trades. That is the most important part because you need to be able to withstand the times where you will lose because y- you will lose. Like it's a guarantee that you're going to lose trades. It's also a guarantee that you're going to win trades. That's the game of probabilities. So how can we position ourselves as traders in the arena that says, hey, you're more probable to win trades if you operate in this part of the arena? Inserts macros, inserts risk management, inserts trading psychology, inserts edge. Gotta have your edge. Gotta have your way to execute, a way to enter the market. Inserts those things. Right? Routine, understanding what market sessions you want to play in, right? Understanding how you mark, how you identify no trade areas. Um, Something that have been poor with in the past. With this funded account, I haven't done it once, and that's trading on my phone, trading while I'm, in the store, at the gym, right, and not treating it as a profession. Sitting at my desk, being locked in, being patient, right? Not only looking to trade when there's entries, not taking every entry, right? Those are the things that put the probabilities more in our favor versus not focused on the macros. Like think about that. And that's the thing for me. I'm gonna weigh both sides evenly. So if it made sense to not focus on the macros, bro, you think I'd be focused on the macros? You think I'd be focused on the macros? If it didn't help to focus on the macros, why would I be focused on them? So if I wasn't focused on the macros, if I didn't have my risk management plan, I just said, oh, I feel like I could risk this much, and I feel like I can make this much, and I'd have a plan I went to every time. Like, come on, come on. I'm not even gonna keep going because it's too obvious. It's too obvious. It's too obvious. Same thing with indicators. Same thing with indicators. Same thing. Could I trade? Could I trade like this? At this point in my trading career, 100%, I could trade without candlesticks. 100%, I could trade without candlesticks. I know breaker structure. I know higher highs. I know lower lows. I know liquidity. I know imbalance. I got my decision making levels. I know exactly how I would trade if I didn't trade with indicators. Like I know exactly what I do, right? But I identified a pattern. We identified a pattern, and it's been 4 years testing that pattern, forward, backward, current, watching that pattern succeed, fail, succeed. Okay. And then finding out what the edge was. So why would I not use something that is literally like this is how I visualize it. And maybe you don't visualize it like this, but maybe there's a way that based on how I visualize it, you can use to visualize it for yourself. But it's like being at a stop I'm at a traffic signal on the road, on a 7th Street in Bell Road. I could pull up to the light. And the light says red. And then the light says green. And then boom, I go through the light. It's time for me to go. It's exactly what these indicators are like. For me, the green light. This is the green light to execute to go. Right? If you wait, what could happen? If you wait too long, what could happen? Yellow light, red light. Okay, now you gotta wait. Now you gotta be patient. Oh, green light again. Boom. You know what I'm saying? Like that's and so I don't look at the noise. I don't look at the noise. Like this noise. Yes, I know I took buys in here. And yes, I know this is decent price movement. This is 58, 60 points. Okay, about $600 on one contract. Right? But to me, this is noise. And yes, like I said, I know I took buys. I'm sorry. It was a behavioral error, malfunction. I malfunctioned. Right? I've readjusted since this morning. Okay. But this is noise. Why is it noise? Because it doesn't support the fundamentals. How can we identify its noise versus this? This is what traders do. Yeah, just knocked over like you probably heard that, but this is what people that make fun of indicators do. They say, okay, oh, we're at this level right here. We're at this level right here. We just had this correction. We're at this level. We're about to, I'm just waiting on this bounce off. I'm just gonna, trade this way. I'm gonna take it this way. Right? But they have no type of way of indicating that could be true. That could happen. Right? And this is not to say maybe they have identified a pattern. Yes, I completely understand and agree with that as well. But every move in the market is unique. Right. And so I think what's interesting about the indicators is if we don't use indicators, we're reading candles. If we use indicators, we're reading data. I think that's the big separator. Yes, the candles are made up of data, but retail traders use candles to say doji or engulfing or they use them for this candle structure, not necessarily the data of a collective of 5 candles. What's the average of the, you know what I'm saying? They use it for the structure. And so but with the indicators, this is based on data, right? And so yeah, could this very well sell off from here? Respect this decision-making level area, ironically being on it. Sell off? Absolutely. However, could it also get stopped at just, a very small liquidity sweep? Or could it fill this area of imbalance on this 5-minute level and then head back upwards, right? It could. It very well could. I don't know what's going to happen. You don't know what's going to happen. Nobody knows, right? However, if we have my confirmations, right, and however you use indicators, this is not me saying use them this way. I'm showing you how the indicators clear the noise along with the fundamentals, like the fundamentals plus the indicators and the psychology and the risk management. Like it's only a matter of time, guys, before like I'm where I want to be as a trader, and that's the most. That's just it's just it gives you the feeling of the great feeling of premonition. If my boy Q was on, he would know exactly why I'm using that word. If you don't know that word, premonition. That's how it makes me feel. Right? And I want you to feel that way too because it's possible. And it's not as hard as it was for me when I spent the first 4 years focused on the wrong things. Right? Useful things, just the wrong things at first. I could have saved a lot of time. Um, but what I would be waiting for is price to make its way down here, which knowing price, it'll do something like this, right? And that's the thing too, the way these, the way the data works, right? But knowing price, it'll do something like this, and then my conversion line, or excuse me, my lead span B will find its way somewhere right here, to where it's right on price, right? And then I'm simply looking for price to break it. My lagging span, I'm looking for my lagging span to break it, right? Because that's going to be moving as well throughout that period. The same thing with price, because it mirrors price, right? It's going to be moving with price, right? And then I'm gonna be looking for it to break. Boom. Once it breaks, I'm looking for seller's volume. Boom. Like it's gonna line up beautifully, right? Seller's volume, ideally below, like, you see how we have it seller's volume, but this signal line is above the midline. I wouldn't take a sell if I saw that, right? Because we could very easily turn around because we're in buying territory, right? So this signal line gives us some feedback to use as well. And so that's just a brief example of how it'll simplify the noise. So I'm not even like, the reason why I was able to talk about everything I talked about on this live stream today, and I know I didn't get to the straightforward moves. I apologize, and I also didn't get to the central bank. That just tells me that I need to come with one or at most two topics to focus on. Because Fed policy took the time, took us into the charts. But I thought it was a very productive session. But I was able to talk about all of that and watch the charts because I'm not focused on the noise, right? And we had news come out. So let's go check on news actually before we get off here. I only want impactful news. Okay, so look at that. Pretty much unchanged, right? Georgia job openings pretty much unchanged from what? The forecast. I want you to know the forecast is more important than the prior month, even though I mentioned what I said earlier, right? Like if we can just look at the prior month, we can see that we're contracting, right? Yes, that's just true from a logical sense. And because I didn't want you to get caught up in the fact that this said below 50 and whatnot, right? The forecast is what matters most because anytime we're significantly above forecast or significantly off of forecast, that hits the markets aggressively, and you'll tend to see strong spikes because of it, right? But this is literally in line with forecast, and so I would take this information with what's going on, like on gold for specifically, and say, okay, how is this going to impact gold today? I would give it a complete wash. I would completely not even think about, not necessarily not think about, but I would say, okay, Joe's job openings and ISM manufacturing, they were both basically in line with forecasts. So they're not going to have a significant impact on price movements today, right? And so what is going to have an impact on price movements today? It's everything that's been in focus for the market. So it's definitely the U.S. Iran Israel conflict and hopeful resolution. That is probably the primary focus, the primary thing in focus because of oil and energy prices and inflation. And then that is in focus because of interest rate policy, right? And that is what gold is looking at to rise or fall right now, right? And that's what is causing, I'm not gonna say gold like it's actually making itself move up and down, but that's what is influencing, impacting gold's rise and fall in prices is ultimately what is the Fed going to do. So, with that being, I am going to sign off of here. I appreciate you guys for jumping on today, and I appreciate those of you that will watch this live stream. Feel free to put anything in the comments that you have. Feel free to educate me on something. If I spoke on something, I'm pretty passionate and I talk, a little bit fast sometimes on some things, but I'm better at catching myself of when I misspeak. So, but if I did not do that today, then feel free to let me know. But if it's something else you want me to dive into and talk about on my next live stream that we have on this channel, the next live stream that we have on this channel, that I can talk about, that you can talk about, or you just want something to see something different related to gold, I'm your guy. We're your guys related to gold, not related to gold on this channel, not the current time. Gold, macros, mindset, risk management, execution, right? That's what we're gonna do. That's what we're gonna be. And so I appreciate those of you, like I said, jumping on this live stream today. No trades were taken, which is fine. Just a little side note: the market has been moving really nice overnight. And then I feel like mid to late New York session, just after that New York London overlap, which is interesting. New York London overlap used to be the very, very liquid session for gold. But just like everything in life, there's seasons, there's cycles. And so we're just here learning how to adapt to these cycles. So I appreciate you listening to me run my mouth, but I hope that you're able to run away with something insightful that you can then run with. With that being said, I will catch you guys next time. Peace.